All right, so there are three types of really bad debt that are going through the car market right now. And the first one is the biggest, and it's the scariest, and that is consumer car debt. And I know traditionally it's normal to have a car loan. It's normal to have car payments. If you watch my channel, you know that I don't like it. I don't like to have any kind of debt. But for the sake of this conversation, let's say that having car debt is normal, having a car payment is normal. So why is it so bad right now? So over the last 2 years, the problem has been that the loan values have just absolutely skyrocketed and not necessarily lined up with the actual values of the vehicles. So over the last 2 years, banks have been loaning for most cases, especially on new vehicles that have had these market adjustments, and a lot of the higher end used vehicles, because prices have skyrocketed. These banks, to actually get these loans done, have had to loan up to 140% of the value of these vehicles. So at some point, somebody has got to get burned on these, because as we know over the course of history, used cars do not go up in value. Now, over the last 2 years, this has been an outlier. There's been supply-demand dynamics that we've never seen in the used car market, but it's all going to normalize at some point, and somebody is going to be left holding the bag on a lot of these loans that are just upside down because the values have been skewed in such a meaningful way. So what do I mean by that? So over these last 2 years, these banks have been loaning way too much money on these vehicles, and the price of these used vehicles are still going down. We take an example. I like to use F-150 a lot on my channel. So over the last 2 years, you can get a nice premium F-150 for the price of MSRP right around $70,000, $72,000 is what I've seen on these stickers. And because they are in such short supply, a lot of dealers were charging market adjustments to the tune of $10,000, $20,000. I've even seen $30,000 market adjustments on a lot of these trucks that had been in high demand. So you take a year and a half ago, a consumer goes and buys one of these F-150s that you can't find, and they pay this crazy market adjustment of $30,000 over this truck. So the truck, just for easy math, $70,000 MSRP from Ford, and then the dealer, because it's in short supply, is charging $30,000 over MSRP for a market adjustment. So now this consumer is in this truck that's supposed to be worth $70,000 brand new. They're in at $100,000. And traditionally, after the course of 1 year, a vehicle will lose 20% of its value just in 1 year. So now this $70,000 truck, we'll do some easy math here, that truck should decrease in value by $14,000 over the course of 1 year, because the customer paid $100,000 for the truck, but the actual value of that truck is not $100,000. The dealer just got their extra 30 grand off of this consumer because you just can't find the truck. So now that $70,000 truck that they paid $100,000 for is actually now worth $56,000. So this customer, over the course of a year, they're making their payments. They might still owe 80 grand on this truck, depending on the size of their down payment. And we know that a lot of consumers, they don't put more than just the minimum of a down payment to get into a vehicle. So this $56,000 truck, what it's worth, they still owe $80,000 in it. So all of these consumers that went this route are so far underwater on their vehicles, and it's not just these F-150s that were crazy money. It's still these $30,000, $40,000 vehicles, these family vehicles. Consumers were still paying these $10,000, these $20,000 markups on all these vehicles over the last year and a half, and now they are ridiculously underwater on these vehicles. And used car prices have not even started to tank yet. We are still at peak of used car pricing right now, and now I believe that the trend is going to start going down and down and down and down from here. So these consumers are just going to continuously just push the values down of the cars that they own, and the loans are going to be even more upside down as we progress, as the values of these used vehicles start going down. So now my worry for the used car market, now I want the used car values to go down. I don't want a lot of people to get hurt, but I feel like a lot of these people who have chose to buy these new vehicles, to buy these ridiculously overpriced vehicles in the last 2 years, I think they are going to get hurt. Just because the actual values of the cars are not going to line up with what they actually paid for it, and the depreciation is going to be much higher than it traditionally is, just because the values that they paid a year and a half, 2 years ago were so elevated. So now here's my worry for these consumers, is that they are going to start realizing that, hey, in this F-150's case, that my truck, the value on it's only $56,000 and I still owe 80 grand. So what they're going to try to do is they're going to try to go and trade that truck in to be able to get a newer truck and try to trade in basically their negative equity and roll it over into a new vehicle. That's what a lot of people do. They do that every 2 to 3 years and just continue rolling this negative equity. They pay down some and then get a new vehicle. But these consumers are not going to be able to do that because they're so far underwater. So they are going to be stuck in their vehicles. And in the case of this F-150, if this consumer sees that, hey, I'm $20,000-$30,000 underwater and I can just go buy another vehicle for way cheaper, then I mean, what are they to do? I know a lot of times this gets related to the 2008 market crash, where people would walk away from their houses. And I really think there's going to be a lot of cases where people actually walk away from their vehicles. So the other problem that we're going to run into with a lot of these loans that were just set up to be bad from the get-go because of the values is that you're going to start seeing a lot of auto loan defaults, a lot of delinquencies tick up. We're already seeing that now. I know that the last figure that I saw, those people with lower credit scores, 1 in 10 of them were already delinquent on their auto loans. Now, what we should see now is a spike in repos at these dealer auctions, but we're not really seeing it yet. And why is that? The reason being is because these banks do not want these cars back. The values have already gone down so much from where these loans were written that these banks are doing everything they can to work with these customers to keep them in these cars, to get as many payments as they can. At the end of the day, these banks are going to end up getting a lot of these cars back because people are just going to stop paying for them. But as of right now, they're still doing everything in their power to keep these customers in these vehicles because the banks know that they're going to lose so much money because the values have come down so much. So the second form of really bad debt in the used car market right now are dealer floor plans. So what a dealer floor plan is, for those of you that don't know, is that many used car dealers, they actually don't have the money to be able to buy their inventory. So they have to borrow money from a bank, from some kind of finance company to be able to buy their inventory to put used cars on their used car dealer lots. And that's called a floor plan. It's basically just the equivalent of a used car dealer swiping a credit card every time that they buy a vehicle at an auction. So traditionally, I mean, this has been how used car dealers have bought their inventory for years and years and years and years. So why is it so bad right now? The reason is that the prices of these wholesale vehicles have spiked so much in the last 2 years that dealers are having to become more exposed to their inventory. They're having to take out much more debt to keep the same level of inventory on their lots than they had prior to the pandemic. So, I mean, I'll give you an example. If a dealer, just for easy numbers, has 10 cars on their lot and they would traditionally spend $5,000, then they would only have the debt of $50,000 for a full lot of cars. So now, since the value of vehicles on a wholesale level, especially at that $10,000 and under range, has gone up so much, in some cases 40, 50%, that same dealer, if they had a lot full of cars, 10 cars, $5,000 a piece, and they traditionally would spend $5,000. Now they're actually having to spend on a wholesale level $7,500 per car. Then that takes their actual amount that their exposure rate up by 50%. So instead of having $50,000 on their lot, they now have $75,000 on a lot. And you can use the same ratio going as many cars as you want to, because there's dealers out there that have full floor plans that have 50 cars. There are dealers out there that have floor plans that have 100 cars on their lot, and they are just getting absolute, their exposure rate is just through the roof at this point. And if you get to a situation where we're in right now, we're at peak used car prices right now, and the values are going to start going down, and demand is going to go down from here. So if you got these values that keep going down and down and down and down, these dealers, because they have this credit card that they've swiped for their vehicles, if they don't sell their vehicles, then their actual inventory cost goes up and up and up and up and up. And at some point, there's going to be a divergence where you have the values of the vehicles going down and their costs going up. At some point, those two lines, they cross. And that's where the problem is going to come in. So keep in mind, at the beginning of talking about this floor plan, these dealers didn't have the money to be able to buy these vehicles to begin with. So if you get to the point where these dealers are losing $1,000, $1,500 per car because they're not moving anything, their floor plan costs are going up, and they just continually sit on this car waiting for these magical customers to come in that have money, which there's no money in the system right now, and interest rates are not coming down anytime soon. So the availability for these customers to be able to get loans on these vehicles is getting tighter and tighter and tighter. So when that's the case, and a dealer that has, let's say, 30 cars on their lot, and they get underwater on these vehicles by $1,000 each, then they have to come up with that $30,000 difference if they're able to sell these vehicles for just a $1,000 loss as the values are going down. And they didn't have the money to begin with to buy the car, so they don't have this $30,000 difference. So then at that point, what happens is they're going to lose their credit lines. And if they lose their credit line, they can't buy any more cars. If you can't buy cars, you can't sell cars. If you can't sell cars, then you can't make any money. So what's the point of being in business? So there's going to be a lot of dealers, because of this exact scenario, when the prices start trending down, that they are just going to be stuck. They're going to owe money that they don't have. They're going to lose their credit lines, and eventually they're going to have to go out of business. And that is my fear for this bad debt in these floor plans, these dealers that are overexposed. I think a lot of them are going to have to go out of business because they just are not going to have the credit availability, because they're going to lose it, and they're not going to have the amount of cash that's going to be needed to operate a used car dealership. All right, so the third form of bad debt that's in the car market right now is corporate debt. So the biggest example of this that we know of right now is Carvana. Last time I checked, they had over $7 billion in debt. And this debt is probably never going to get paid out. So Carvana is spiraling out of control, and they are heading for bankruptcy right now. And at some point, they're going to have to try to raise more money if they want to try to stay alive for any time longer. And I don't believe that they're going to be able to do any kind of raises to be able to actually get any money. We've seen this recently with American Car Center. They tried to raise some money to be able to stay afloat, and they offered some bonds in the form of debt, and they were actually not able to find any buyers for this debt. So they had to immediately just close their doors. They shut down a lot of their dealerships, even to the point where they sent out a letter just saying to all employees, hey, you're fired, we're not staying open. And the customers didn't even know where they were going to be able to pay their car payments that were still owned by American Car Center. The car market right now is not a place to be. We can all see the writings on the wall, delinquencies going up, repos going up. We're seeing that the value of used vehicles is going down. New car dealers are having a hard time selling vehicles right now. Interest rates are still on the move up. It's going to be a tough run for used car dealers, for franchise dealers, for corporations that are in the car market right now, and for the rest of this year. It's going to be really tough sledding. So that's why debt is such a big worry that's at least on my mind for the car market, both on the consumer side, the used car dealers that are overexposed in these floor plans, and for any of these corporations like Carvana, like American Car Center that just recently went under. It's just really a setup for disaster. There's too much leverage in the system, and at some point it's got to come out, and somebody's going to be left holding the bag.